AM Best has released reports on 2022 rating trends in the property casualty and life health insurance segments. And here to discuss the findings are Helen Andersen, Industry Analyst, and Jason Hopper, Associate Director, Industry Research and Analytics, both of AM Best. Helen and Jason, welcome. Thanks so much for joining us.
Hi, Lori. Thank you.
Helen, looking at P&C, how did the upgrades and downgrades cut across personal and commercial lines?
So in the personal line segment, in 2022, we saw 10 upgrades versus 18 downgrades. And in the commercial line segment, we saw 26 upgrades versus 11 downgrades. So 72% of total upgrades were in the commercial line segment, and 62% of total downgrades were in the personal line segment. It was a bit of a rough year for personal lines.
A little bit of a different story on the life health side. Jason, with no large swings, though a few downgrades on the health side, what did you see there?
Sure. Thanks, Lori. So there were more downgrades than in 2021. But having said that, overall, there were still more upgrades than downgrades across both segments, the life annuity as well as the health. The reasons for upgrades can vary, but on the downgrade side, balance sheet strength was typically the driver. Risk-adjusted capitalization has been pressured. You have rising interest rates. You have inflationary pressures. You're still seeing some impact, morbidity and mortality from the pandemic, although those impacts are less severe than they were earlier on in the pandemic. But nonetheless, those are some of the main drivers of the downgrade side.
Back to P&C, Helen, what were some of the overarching reasons that you can see driving rating movements?
So overall, there were fewer upgrades and more downgrades in 2022. And as particularly for the downgrades, balance sheet strength and operating performance were the two biggest factors across both lines. You had inflation driving higher loss costs, especially for personal auto. There were heightened catastrophe losses, and there are increasing reinsurance costs. Carriers are still pursuing rate adequacy, but it's a challenge to stay ahead of current trends.
Jason, you mentioned capital declines on the life health side. Do unrealized losses pose a threat to companies' ratings in 2023?
So interest rates rising is an issue. It pressures bond prices, valuations. But at the same time, insurers are generally a buy and hold industry. Life insurers, obviously a little bit more longer tail to match their liabilities, health, more shorter tail. But back to the unrealized losses, that really only becomes an issue if there are underlying liquidity issues where the insurer has to sell assets that are not yet matured, and those would likely lead to a loss with the depressed bond valuations, as we noted before. So that's really kind of the driving factor, whether unrealized losses are actually going to impact capital and surplus in the balance sheet. But as I said, it's typically a buy and hold industry. So cases notwithstanding, generally speaking, we wouldn't anticipate that being a huge driver.
There were less outlook revisions, under review ratings across the board. Jason, coming out of COVID, is market uncertainty easing up somewhat?
Sure. I mean, to some extent, mortality and morbidity is easing now compared to earlier on in the pandemic. But I would note the outlooks and under reviews were more inflated in 2021. Compared to 2022 being a little bit more depressed. There was a lot more M&A activity last year that has since closed. These acquisitions are now more integrated and more embedded with their acquiring companies. So that's kind of the function related to under reviews and outlooks.
Jason and Helen, thank you so much for speaking with us today.
Thank you, Lori.
Thank you.
That was AM Best Associate Director, Industry Research and Analytics, Jason Hopper, and Industry Analyst, Helen Andersen. For AM Best TV, I'm Lori Chortis.